How are you doing, everyone? I'm Rick, and in today's video we're going to list my top 7 growth ETFs that you can invest in 2022 to take advantage of this bad recession. Now, the recession is unfortunately not a surprise anymore, and in 2022 we've seen many investors shift from growth investing to more safe and less risky companies. And I can understand that. This has brought giant companies like Meta, Amazon, Nvidia, AMD or Shopify to lose up to 50% of their value. But as Warren Buffett says, be greedy when others are fearful. So if you are a growth-oriented investor, now it's a perfect time to invest in ETFs in the growth sector, because after a crash, a great growth always follows. At the end of the video, I also want to show you in a clear way something that if you don't know it already, I swear it's going to blow your mind. It's about the so-called expense ratio or management fee of the ETF, which is basically what the company that created the ETF takes from US fee every year. So stay till the end of the video because really you can't even imagine. But now let's not waste any more time and let's start with the number 7. Coming in at number 7 we have Vanguard Megacap ETF or MGC. This ETF has 3.8 billion under management, a dividend yield of 1.46% and an expense ratio of 0.07% or $7 annually for every $10,000 invested. As opposed to the S&P 500 index, MGC offers a mega-cap approach that is focused on 240 of the very largest US stocks, with a 31% focus on the technology sector and with the biggest 10 holdings occupying 33.9% of the net assets. This ETF provides a great way to get a diversified exposure to the top US stocks, representing around 70% of the total market capitalization. In the last 5 years, the Vanguard Megacap ETF grew with a cumulative return of 93.11%. That means that if you invest in $10,000 5 years ago, you would now have roughly $19,300. Now, the largest holdings in this ETF are Apple, Microsoft, Alphabet, Amazon, and Tesla. In the Vanguard's website, this ETF is represented with a risk potential of 4 out of 5, meaning they consider it a moderate to aggressive fund. If you want to know what that means, we can say that funds with a risk level of 4 are appropriate for investors that have a long-term investment horizon, like 10 years or more. Coming in at number 6, the iShares MSCI EAFE Growth ETF. This ETF has 8.8 billion of assets under management, a dividend yield of 1.9% and an expense ratio of 0.35% or $35 annually for every $10,000 invested. The advantage of this ETF is that it allows you to diversify by focusing on Asian, European and Far East companies. Now, to be precise, Japan, Singapore or Hong Kong are the only Asian countries or regions that are included in this ETF, covering respectively roughly 22%, 3% and 1%. Australia is also in with around 7-8% and the rest belongs to Europe. This ETF focuses on large cap stocks and contains companies like Louis Vuitton, Roche, Nestlé or AstraZeneca. As you can see, these are all corporations larger than $100 billion with powerful multinational operations. So you're not investing in high risk emerging market stocks here. The good thing is also that even the biggest companies of this ETF don't take up more than 4% of the total portfolio. Moreover, the sector distribution is not strongly focused on the information technology sector, which is strongly volatile, but instead in industrials and healthcare. This gives the ETF a stability factor that is going to give you peace of mind during the future market fluctuations. So if you really want exposure to rising sales and profit regardless of geography, then this ETF is probably one of the best growth ETFs that you can buy. Coming in at number 5, the IShares U.S. Technology ETF, for those who love the technology sector. With 7 billion of assets under management, a 12-month trailing dividend yield of 0.3% and an expense ratio of 0.41% or $41 annually for every $10,000 invested, IYW seeks to match the performance of the Dow Jones U.S. Technology Index before fees and expenses. It offers you the biggest name in tech companies like Apple that accounts for a total of 18% of total assets, followed by the Microsoft Corporation with around 16% and Alphabet Inc. Class A and C together for a total of around 11%. This fund is sponsored by BlackRock and is one of the main ETFs trying to match the performance of the technology broad segment of the equity market. The iShares U.S. Technology ETF holds a ZEX ETF rank of 1, namely Strong Buy, which is based on expected asset class return, momentum, and expense ratio, among other factors. Because of this, IYW is an outstanding option for investors that seek exposure in the technology sector. Moreover, this ETF has a beta of 1.12, and with around 164 holdings, it effectively diversifies company-specific risks. This ETF had a cumulative growth in the last 5 years of around 215%, meaning if you invested $10,000 5 years ago, you would now have $21,500. And this after taking into account the big crash that afflicted many ETFs or growth ETFs like this one. At the number 4, I'm placing the Invesco S&P 500 GARP ETF. With 843 million of assets under management, a dividend yield of 0.8% and an expense ratio of 0.36% or $36 annually for every $10,000 invested, the GARP ETF stands for Growth at a Reasonable Price. This fund is a passively managed ETF designed to offer broad exposure to the large cap growth segment of the US equity market. It includes roughly 75 companies that are included in the S&P 500 index and has GARP characteristics. These stocks are scored and selected not only by fundamentals like earnings per share or revenue growth, but also by valuation metrics like return on equity and price to earning ratio. Over the last 5 years, this ETF has performed strongly and it offers the heaviest allocation in the healthcare sector, about 30.9% of the portfolio. Information technology and financials round up with around 18% each, and then we have industrials with 13%. With a 5-year return annualized of 20.8% per year, the GARP ETF outperformed the S&P 500 index in the last few years. And if you want an ETF that scores companies based on all valuation metrics, then this is a great option for you. Coming in at number 3, we have the Vanguard Megacap Growth ETF. With 10 billion in assets under management, a dividend yield of 0.5% and a ridiculously low expense ratio of 0.07% or $7 annually for every $10,000 invested. Vanguard's ETFs always make the top of the list, of course because of their performances, but also because of low expense ratios like this one. Now, if you think, yeah, 0.07% expense ratio is great, but also 0.7%, come on, it's not so bad. Well, then you need to see the end of this video because I'm going to show you how this small difference in the management fee is going to make you poor in the long term. But now let's come back to the Vanguard Midcap Growth ETF. This ETF focuses on mid-sized US stocks, and this is a great feature because these companies are neither too large so that they risk being too mature, nor too small so that they risk going bankrupt because of a few bad quarters. This $10 billion fund has just under 200 stocks, with top holdings like the diabetes monitoring company Dexcom and the semiconductor company Synopsys, among others. Although I guess you've never heard of these companies, see it like this. We're talking about a total of $80 billion of market value for all the companies in this ETF, which is huge. But still, they are not companies that everybody talks about, so that they carry less risk of being overvalued. Now, on the sector level, VOT is focused on technology with around 30%, while other sectors like materials, utilities, consumer staples, and telecom all collectively add up to around 7% of the portfolio. Coming in at number 2, we have the iShares Russell Top 200 Growth ETF, IWY, with 4.4 billion in assets under management, a 12-month trailing dividend yield of around 0.64%, and an expense ratio of 0.2% or $20 annually for every $10,000 invested. This fund is sponsored by BlackRock and is one of the largest ETFs to try to match the performance of the large cap growth segment of the US equity markets. Large cap companies usually have a market capitalization above 10 billion. They tend to be stable companies with predictable cash flows, and they're usually less volatile than mid and small cap companies. This ETF grew in the past 5 years with an annualized average return of 22%, which is just crazy. To give you an idea, if you invested $10,000 in this ETF 5 years ago, you will now have $21,000 in your portfolio. Now, doubling your money in 5 years is already a great result, but consider that if you sold in January 2022, just before the crisis started, you will now have $28,000, almost 3 times more of your initial investment, and this in only 5 years. So now we got to the number 1 of the list. As number 1, I couldn't help choosing the Vanguard Growth ETF, the leader among large cap growth ETFs. 74.2 billion in asset under management, a dividend yield of 0.6%, and an expense ratio of only 0.04%. Yes, you've heard correctly, just $4 annually for every $10,000 invested. The Vanguard Growth ETF is the most known growth fund, and of course it's biased toward blue chip technology stocks, with top holdings including Apple and Microsoft. Now there is not much to say about this ETF because overall it's probably your best option if you want to invest in growth companies and have a great long-term return. VUG is the simplest way to gain cheap, diversified exposure to all the big companies that come to your mind if you think about growth. It's not as sophisticated or particular as other ETFs that I mentioned, but that's also its strength point because you can just dollar cost average on this ETF and it offers you a straightforward approach to growth via large US companies. Now, I told you at the beginning of the video that I would show you something about the expense ratio or the management fee of the ETF, and if you didn't know it already, it would blow your mind. So here we go. Let's say you want to invest in 2 ETFs and that both of them are going to give you a 9% return per year. Only the second ETF has an expense ratio of 0.7%, while the first ETF has an expense ratio of 0.07%, like most Vanguard ETFs. At first glance, you would say that 0.7% of the second ETF is not such a big deal. If you think about it, it's just $70 every $10,000 invested. But let's see what's the impact in the long term. If you keep both investments untouched for 45 years, because let's say you save for retirement or you're a long-term investor, then the $10,000 investment on the ETF number 1 becomes $468,000, while the investment in the ETF number 2 only becomes $352,000. So the difference between the two results, which amounts to almost $116,000, was all eaten by the expense ratio of 0.7% of the ETF number 2. So just because you chose 0.7% over 0.07%, you end up having 25% less than what you would have if you chose the ETF number 1. I think it's just crazy that a difference of 0.63% in the expense ratio can give you a loss of over 25% in the long term. So always check the expense ratio, the lower the better, and even a small difference can mean a big loss in the future. Alright, these were my 7 picks on growth ETFs that you might want to invest in considering this market crisis and the recession that we're experiencing. And remember that dropping prices shouldn't frighten you, but instead you should see it as an opportunity to buy at a cheaper price. By the way, this is my first video where I list ETFs to invest in, and I'd love to know from you if it's something that interests you, because usually in my YouTube channel I focus on more general topics about personal finance and self-development. If you like this content, don't forget to subscribe to my channel, hit the like button and ring the bell so that you will be informed when I publish new videos. So take care, stay away from high expense ratios, and I'll see you in the next video. Ciao!